Sorry.
Sorry, no. My name is Joyce. I'm a member of CARY Toronto, and I'm in church. I collaborate with Raisa on mental health, but today we'll be talking about life insurance. So the Canadian Association of Rwandan Youth Toronto is there and committed to connect and engage with the Rwandan youth with developing their skills, sharing knowledge, and that's what we're going to be doing today. And allow me to introduce Nicole Simons. She's our wealth management advisor as well as investment advisor. She'll be talking to us about life insurance. As you've seen in the last couple of days, weeks, and last year, we've had some misfortunes where people had to get some GoFundMe and all that. So as a community, we decided it should be important that we talk about life insurance, and we're delighted to welcome her so she can talk to us and share her knowledge in regards to life insurance. Welcome, Nicole.
Yes, wonderful. Thank you, Joyce, for that introduction. So let me share my screen. You guys let me know if you can see everything so I can get started. All right. Can you guys, Joyce, are you able to see everything?
Yes.
All right. Perfect. All right. So thank you guys so much for having me today. I'm delighted to be here to talk about life insurance and definitely how it can be an asset to your life. So feel free to write down any questions that you have. And of course, I'll be glad to answer them at the end of my presentation. And yeah, I hope you guys find this very informative. So a little bit about me, myself. Like Joyce said, I am a wealth management advisor for my actual family business. So this is a little snapshot of my family, minus my mom, but that's my dad and my siblings, Colin and Peter. CPN Financial Services is actually the company that I work for. My dad started this business actually over 30 years ago when I was a kid. He was a very successful insurance broker and investment advisor himself. And he wanted to make a legacy for his family. So he started his own company and called it CPN Financial Services. And CPN actually stands for Colin, Peter, and Nicole. So I am the N in CPN Financial. And of course, my siblings are the C and the P. So we are actually one of the very few Black-owned, financial institutions or brokerages in the GTA. Like I said, we've been in operation for quite a long time now, and we have other brokers that work for us as well. So it's our job kind of to help our clients build that financial fence so that in the event of either premature death, critical illness, or disability, that their families are, very minimally financially impacted. One of the other actually parts of our business is our non-for-profit called Seeds for Success. So Seeds for Success was birthed in, I believe, 2018, started by my brother. My brother and I started, Seeds for Success because a lot of our clients were starting to, get into financial literacy and wanted to have their kids benefit from this knowledge as well. So we thought, okay, why don't we start having workshops teaching kids or the youth about financial literacy? So we started hosting workshops around the GTA. Our main hub was Brampton, which is where this picture was taken here, but we held workshops basically every Saturday with two groups, I believe age 7 to like 12 and like 13 to 18. And we would teach different concepts from how to save, how to have a positive money mindset, writing checks, insurance, all of that. So it was really successful. Unfortunately, due to COVID now, we haven't been able to have any in-person workshops, but we are slowly transitioning now into our online workshops, which I believe just launched today. So you can check us out at seeds4success_ on Instagram to find more information about that as well. But yeah, that's our non-for-profit. So if you have any kids or anybody interested in learning more about financial literacy, check us out there as well. So a little bit about me. I'm a soon-to-be mom of 2. So I'm currently expecting, a little girl right now, which is why the face you're seeing here does not match the face that's in the picture there, because I am in the home stretch. I think I'm about 4 weeks away of giving birth. So soon-to-be mom of 2. I'm a financial literacy advocate. And once again, my main bread and butter, of course, is life insurance and all different types of insurance. I also tackle critical illness insurance, disability insurance, health and dental for people who are self-employed and want benefits for, prescription drugs or dental, of course, then I provide plans for that as well. And then on the investment side of things, I help my clients build wealth through investments such as TFSAs, RESPs, RRSPs, and leverage loans. Leverage essentially is borrowing to invest. So that's a whole other topic, but basically that's one of the things that I do as well. So like I said, my main goal is to, help my clients build that financial wealth, but more importantly, make sure that their financial fence is covered. So in the event something happens that, there's money there for protection. So one of the questions, or a few of the questions that I like to ask my clients in regard to their fence are as followed. So right here, here's just a few that I kind of want you guys to think about, even for your own personal lives. Like if you were to pass away, and let's just say you had any kids, how would your kids be financially impacted, right? If you were to pass away. And more importantly, if you had a child that were to pass away, how also would that impact your life financially as well? A lot of people don't tend to think about those things. They're not exactly the funnest topics, but at the end of the day, it's reality. And, I encourage people to be more proactive than reactive. On the illness side of things, if you were diagnosed with a critical illness and needed special care during your recovery time, would you be able to afford it? Right? A lot of the times people don't have necessary savings in place for things like that. And you only really think about it when it happens to you, right? And lastly, if you were injured on the job and could not work for several weeks, how would that impact you financially? So a lot of us, whether we're self-employed or work a 9 to 5, we depend on our hands, our legs to get us from point A to point B. But if we were seriously injured and weren't able to work anymore, do we have savings in place? Do we have a plan in place that will allow us to still continue, have income coming in to pay our bills? Because just because you're injured, bills still got to be paid, rent, mortgage, car insurance, car payments, those don't stop because you're injured. So what type of plan do you have in place? So those are a few things that I talk about in regards to building financial fence. But today we're going to be focusing on life insurance. So what is life insurance? So life insurance is essentially a contract that you would have between yourself and the insurance company, and they will pay out a lump sum known as a death benefit to your beneficiaries in the exchange for you paying your monthly premium each month. So you would choose a death benefit amount, let's just say 500,000, $1 million, 100K, you will decide that amount with your advisor. But as long as you're making your monthly premiums, whether you do it monthly or annually, the contract is that they will pay out that death benefit if you were to pass away. Life insurance also takes an insignificant monthly premium and turns it into a significant tax-free lump sum payment that will change the lives of your loved ones left behind. Now, this is really important because, a lot of people, one of the main questions I tend to get asked is, Nicole, if I get life insurance and I pass away within 6 months, will it pay out? Yes, it will. Yes, it will. That's how life insurance works. The actuaries that design your plan and approve you, they basically have numbers that kind of guesstimate how long our life expectancy is. And it's a gamble both for them and yourself, but more for them that, if you pass away at any point in time, that they're going to pay out. So it doesn't matter if you've only had the policy for 6 months or 2 months, as long as, there's not any type of fraud and you, of course, were very truthful on your application, you could have paid very minimal into that policy and your family would be hugely financially impacted in a good way just by you making sure you have life insurance in place. So today we're going to talk a little bit about the different types of life insurance, kind of high level, so that you kind of have an idea of the type that you have to choose from and the benefits and how it creates generational wealth as well. So during this conversation, I want you guys to think about what your financial legacy will be. A lot of us sometimes don't really think about that. It's not something that's at the forefront of our mind, especially if we don't have kids, we're single, not really thinking about that right now. But you have to understand that, the information I'm giving you now and the information that's around you right now, if you take that in and put that into practice, you really are setting yourself up for financial success and the generations after you for financial success just by you taking the necessary actions now. So even though you might not have thought about your legacy, I want that to be in the back of your brain while I'm providing this information. And this also will kind of help you choose and navigate what type of life insurance plan would be best for you as well. So let's talk a little bit about why you need life insurance in the first place. I think when people think of life insurance, there's the obvious, you want to make sure that there's money there for burial and final expenses, but there's other things that life insurance can be used for as well that are just as important. So for example, the first one provides replacement income. Replacement income is important, especially if you live in a two-person household, you and your spouse, let's just say you and your boyfriend, whatever the case may be. If somebody is dependent on you financially to help stay or live in the home, life insurance is important. For example, let's just say a two-parent household. A lot of the times, one spouse might be responsible for the mortgage, and the other spouse might be responsible for, let's say, the utility bills. But if the husband were to pass away, a lot of the times the wife can't necessarily afford to live in that house by herself. She can't afford to pay utilities, things for the children, and the mortgage. So by having a life insurance policy, you can make sure that replacement income is provided so that you have a lump sum payment paid out to you, and you can take from that insurance policy as if your spouse was still here financially. So replacement income essentially just means replacing the income that your significant other brought to the household so that your family is minimally financially impacted. Speaking of house, pay off mortgage on your home. So if you have a life insurance policy that's big enough, you can literally just pay off the mortgage for the household, and then you can remain in your house and not have to worry about that large bill anymore. Because that, for a lot of people, is a big stressor, being able to pay the mortgage with other bills, right? So if you can pay that off with a life insurance policy, that would be amazing as well. Life insurance also can be used to pay off any outstanding debts. It can be used to provide for your children's education. So to elaborate on that, me, myself, I have an 8-year-old son right now, and I diligently, of course, put away every month into his RESP. But if something were to happen to me, those payments essentially would stop unless his father decides to continue. But what that means is that the dreams of my son being able to go to school OSAP free, for example, might get cut short. But with a life insurance policy in place, if you have, this significant amount that's needed, you can then fund your child's education. The spouse that's left, if I'm gone is what I mean, can then fund the education without having to worry about, now making monthly payments into an RESP. There's also creating inheritance for your family. So we're going to talk about that more later in the presentation about how life insurance can be used to create generational wealth. But yeah, it's more than just a burial. If you want to actually leave your family in a better financial position than when you were here, life insurance is key for that. You literally can leave a significant lump sum to your family to make sure that they continue way better off than when you were here. Life insurance can do that. And of course, I mentioned funeral costs and final expenses. So there's basically two types of life insurance, two main umbrellas is what I call it. There's term and permanent. So we'll start with term coverage first. Term insurance essentially is a great solution for temporary needs. When you have term life insurance, it means that you are buying life insurance protection for a certain period of time or a term. So you're able to get a 10-year term, 20-year term. Some companies will give you up to even a 40-year term. And what that means is that you're going to pay a monthly premium or annually if you choose. And if you happen to pass away during that term, the life insurance company will pay out the death benefit. So if you don't pass away during that term, which tends to be a lot of people's number one question, then of course the policy is not going to pay out because you were not supposed to pass away, but basically because you didn't pass away during that time frame, they don't have to pay anything out. So initially, term coverage tends to be a little bit on the cheaper side. It's very inexpensive because statistically, life insurance companies know the chances of you passing away within the next 20 years can be very slim, especially if you're young. So they can charge you, a pretty cheap rate because they know, yeah, chances are you're not going to pass away in this 20 years, so we can give this to you for a cheaper price. However, when that term is up, you have the choice to renew your coverage for another 20 years if you want. But by that time, you're 20 years older. And because you're 20 years older, the price is not going to be the same because now there's more risk to the life insurance company because you're older, health problems may start to occur. So they're going to charge you more. So you could be paying, let's say, $15 a month now. and the rate will skyrocket to maybe $200, for example, in year 21 when you renew the policy. So people tend to not like term insurance that much because they don't like the idea of their premiums renewing in the future. But for some people, it's the best for them if they have a tight budget or if they have a lot of debt mortgage they're trying to cover, because term insurance will allow you to get a large amount of coverage for a really decent price. So when you compare it to permanent, term will always be less expensive in the beginning, but it actually ends up costing you more. And I'll explain that in a second. So let's look at some premium comparison. So I just put here a female and a male, both the same age of 35 years old. And this is just showing what the cost would be for a 20-year term for $100,000. So for a female, the monthly premium for $100,000 would be $12.42. And for male of the same age, non-smoker, it'd be $14.76. So you might be thinking, Nicole, like they're the same age, why does the male cost more? Well, sorry guys, males do cost more when it comes to life insurance because women do tend to live longer. So at any point in time when you're getting a quote for male and female same age, the male will always cost more just due to the fact that we tend to live longer. So life insurance companies do charge a little bit more for the males. So sorry, guys. But if you look at the renewal rate just below that, that is exactly the cost the term coverage is going to renew at in year 21. So for the female, she'll go from paying $12.42, and then in year 21, it'll renew to $143.73 in year 21. That would be the renewal costs. For the male, same thing, $14.76 monthly now, but in year 21, it's going to renew to $156.69. So at that point, at the renewal stage, you have the choice of renewing the coverage if you want and paying that new rate. You can cancel it if you want. If you don't want to pay and you're like, you know what, I can't afford this, you can cancel it. But think of term insurance like car insurance. We pay every month. Even if we don't get into any car accidents, we still got to pay and we don't get any money back. So term insurance, there's no money back. There's no option that, okay, I didn't die, can I have my premiums back? Doesn't work that way. So if you cancel the coverage, that's it. You fulfilled your term. The life insurance company got their money. You had your protection for that 20 years, and that's that. The third option is if you still want some coverage, but you want it more for long term, you do have the ability to convert some of your term coverage or all of it to permanent, which I'm going to talk about next. So permanent insurance is essentially the opposite of term. It is permanent. You have it for life. The price is not going to increase. It's not going to change on you. And whether you pass away at age 25 or at age 101, it's guaranteed to pay out because unfortunately, you have to pass away at some point. So it's designed to protect more permanent needs. There's different types of permanent coverage, which I'm going to get to in a second. But basically, if someone says, Nicole, you know, what would I use permanent for? Permanent is great for people who want to have life insurance coverage for life. It's for people who, no matter what, at age 25 or age 85, they want to make sure that there's money there intact for their final expenses. It's also great for creating generational wealth because permanent coverage with the different types often offer a cash value component, which I'm going to talk to you about in a second. So that being said, it creates that wealth because cash value can be used while you're alive, or it can be passed down to the generations after you through your beneficiaries as well. So the main benefits of permanent, once again, is that you have it for life. The price does not change. Compared to term, at first, it will be more expensive. But remember, the term price ends up increasing in X amount of years, where the permanent price does not change at all. So in the long run, permanent actually ends up being the cheaper option because the price does not change. And it's great for estate planning. So I was mentioning just a second ago that there are different types of permanent coverage. The two main types that I think you guys would have heard of is either whole life and universal life. Those are the main two that I think people talk about the most. Whole life, it offers a fixed monthly premium and a guaranteed death benefit. So once again, the premium stays the same, does not change, and you have a guaranteed death benefit. What I like about whole life is that you have the opportunity, if you have a participating whole life policy, to get company dividends. So as a whole life policy owner, you are eligible to participate in company earnings in the form of a dividend. A dividend essentially is like a cash payout that you can get into your policy that you can use for many things. So the dividend can be taken as cash, it can be added to your cash value, it can be used to pay for premiums in the future, or what I like about it is that it can be used to buy more coverage called paid up additions. So the dividends that get paid into your whole life policy, there's a few ways you can take it, like I just said, but what I like is that each year when the dividend gets paid into the policy, it'll buy you more coverage. So I'm going to show you what that looks like in just a second. On the universal life side, it's also permanent coverage that you have for life, but it provides a little bit more flexibility because it allows you, the owner, if you want, to do something called overfunding. Overfunding is where you are able to put extra money that you have personally into your policy, and that money will grow tax-free. So for example, if the premium requirement for the month is $50, but your budget is $100, you can literally pay an extra $50 into your universal life policy, and that $50 will go into an investment fund that you will pick with your advisor based on your risk tolerance. And that $50 will grow and compound over time tax-free. So it's a great place if you've maxed out your TFSA, if you've maxed out your RRSP, and you're looking for somewhere extra to put some money and have it grow, you can put money into your universal life policy and have that grow over time. And what's cool about that is that if you happen to pass away and you have significant cash value in there, that also will be paid out tax-free to your beneficiaries as well. So there's some more wealth creation there. You have your death benefit, but you also have your accumulation fund that you've worked so hard to build over the years that gets paid out tax-free. You also can take from your policy, borrow from your policy. If you want to take, 10 grand out in 20 years because you want to fix your roof or you want to pay down some debt, it's your money that you put in extra. So you are able to take it out and do what you wish with it as well. So let's look at a cash value comparison. So once again, universal life and whole life both offer cash value components. Just universal life, for example, gives you a little bit more flexibility for you to be able to choose how much extra you want to put in if you want. So on the left-hand side, we have a whole life policy where it's a little bit more rigid. You don't really choose how much you want to put in extra. It builds cash value on its own. So at age 60, this 35-year-old female would have approximately $67,000 in there, and her monthly premium would be $143.73 a month. On the universal life side of things, the actual cost every month for this $100,000 is only $66, but she has an extra $100 that she can afford to put into her universal life policy. So every month, $166.42 will come out of her bank account, and that $100 will be invested into an investment fund of her choice. Now, this calculation is based at 7% interest. So this is saying that she's getting 7% on her money year over year. And at age 60, she'd have about $85,000 at that point, based on her starting it at age 35, putting in $100 extra and getting 7% year over year. So both of them offer, flexibility in a sense where there's guaranteed cash value on the whole life side. And then on the universal life side, there's cash value based on what you put in extra. You don't have to overfund your policy. I have many clients that take universal life and don't have the extra funds right now to put in. That's fine. All you're required to pay is the minimum cost of insurance. So in this case, it'd be $66.42. That's all you'd have to pay to have that $100,000. But if your finances permit, you are able to put in some extra money. Now, as you can see, this is a big stretch from the term, right? $12, $14 to $100. Like whole life and universal life definitely cost more. But remember, like I said before, this is permanent coverage that's always going to be there, right? And these prices are not going to change. Whereas term coverage, it starts out being really cheap, but as the policy continues to renew, you're going to see the increases as well, which are actually going to be contractually in your policy. So you'll know ahead of time what those increases will look like. So whole life, because it's a little bit more on the expensive side for adults, I tend to do a lot of whole life policies for kids because the way life insurance works is the premiums, the monthly premiums are pretty much based on your age and your sex, right? So male, female, and how old you are. And kids and babies, for example, are super young. So the pricing tends to be a lot cheaper. And a lot of parents gravitate to whole life for kids because they say, okay, Nicole, I have an RESP already. What else can I do for my child to create some wealth and to create some cash value? Whole life is great for that because not only is it a cheaper price, depending how it's structured, but your child will have access to cash value in the future that they can use for whatever they wish. It could be used for school, down payment of a home, wedding, whatever the case may be. This is something that my dad did for me when I was a child, and now I've done for my son, and I'll definitely be doing for my daughter as well. So I'll show you in a second what that looks like. So this is just a little snapshot of what generational wealth with life insurance looks like, okay? You as an adult, if you have a child, can take out a policy on your child, a whole life policy. Because you're the owner of the policy, you have access to all of the cash value. So let's just say you're a mom and you take it out on your son, Brian. So as you know, Brian gets older, and as long as you have the policy, the cash value starts to build over time. You as the adult or the owner of the policy can access that cash value to do whatever you wish at any point in time. However, let's just say now you get older and eventually, you pass away. You would have structured the policy to have Brian be the contingent owner of the policy, meaning that if something happens to you, Brian will now become the owner. So if you look down here, after you pass away, Brian now becomes the owner. And now whatever cash value that was in that policy, he will now have access to. If you didn't spend it all, he will now have access to the cash value in that policy. And because he's the owner of the policy now, and now he has his own kids, he can make his kids the beneficiary on that policy now going forward, so that if and when the death benefit pays out, it'll pay to his kids. So now when Brian dies at the age of 80 years old, now his kids, which would have been your grandchildren, now get that death benefit. So this is just a little snapshot of how one life insurance policy can pass down through 3 generations, okay? But for many of you who don't have kids, that's not your concern. You want to get a policy on yourself. So you, like I said, have the ability to get a whole life policy or universal life policy on yourself. You can make the beneficiaries whoever you like at this time. And don't think that whoever you choose, the beneficiaries are written in stone. If the beneficiary right now, for example, is your mom or your dad or your sister or brother, and then let's say in the next 5 years, you happen to get married and have kids, beneficiaries can always be changed at any point in time. So you don't have to worry about that being locked in or that, you can't change anything. That can always be changed. Back to what I was saying about, insurance for kids, though. This is just a little chart that I wanted to show you guys so you can kind of see a real life example of what this looks like for a young child. So this is essentially a chart or a projection, should I say, for male, age 1. The monthly premium is $125.37 a month. The reason why the premium is a little bit high is because most parents don't like the idea of paying for this policy forever. They want this policy to be paid up in a quick amount of time. So you have the option as the owner of doing a 20 pay. A 20 pay essentially means that the life insurance policy will be paid off in 20 years. So for 20 years, you'll pay your premium, and in year 21, the policy will be paid off. Okay, so in order for you to get that type of policy, you're going to be paying a little bit more a month because you're basically fast tracking so that the policy is paid up in full. So this is coverage literally that I just took yesterday, so you guys could see a chart for a 1-year-old male, and it's a 20 pay. So if you pay attention to right here, you'll see that this is the premium annually, so $1,500 for the year. And you'll see starting after year 20, it goes down to 0 here because now no further premiums are required after that. Starting in year 1, guaranteed cash value starts to build in the policy. So every year you'll start to see contractually cash value being, grown within this policy. The death benefit is $100,000. So that's how much you signed up for this child to get. This column over here is guaranteed because contractually in your policy, you will see these same numbers. So you'll know no matter what, in year 15, there's going to be 12 grand. That's contractual. So you know that there's always going to be cash value there based on the numbers you see in the policy. This column over here is the dividend. So remember I was talking before about you're able to get company dividends from the actual insurance company. So this insurance company, of course, this is Equitable Life that I'm using in this example, pays a dividend of, I think, 6.05 right now. Not 6%, but it's basically the calculation they use to calculate the dividend. So the reason why it says non-guaranteed is because dividends technically are not guaranteed every year. Although most top insurance companies, they literally have been paying dividends for over like 50 years, but they do say technically they're not guaranteed. So that's why it says non-guaranteed in that column, because it's not going to be in your contract. The dividend scale changes year over year, so they can't guarantee what the dividends are going to be, but they definitely can give you a projection based on what the dividend is now. So long story short, the dividend on this side is basically being paid into the policy, and that would be this column right here. It's a dividend cash value. Now, what I like about these type of policies is that, remember I was saying you can use your dividend to buy more insurance? So every single year, that dividend is buying more insurance coverage. So you see in the beginning, you had 100K when you started, but every single year, this dividend is buying more and more coverage. So the policy is growing with your 1-year-old child. So start out at 100, but it's growing every single year. And what I love about this policy the most is that when this policy is finished being paid for in year 20, your death benefit is still growing year after year after the policy's been paid off. So this is another example of how generational wealth can be passed down, because as you can see, this death benefit has grown to over $500,000 by age 60. And if you never touch this cash value at all, this death benefit column that's at 586,000, let's say at age 60, if you were to pass away, now that's the death benefit that's going to be paid down to your child, right? So my point is that, sorry, not to your child, it'll be to your kid's kid, should I say. If you took this out on your kid, so when you give this policy to your kid to change ownership, if you want, because that's an option, you don't have to. But if you give this policy to your child, and now when your child is older, they make their children a beneficiary, that's basically the death benefit that their kids will get, right? So it's important to this is why I was talking to you about legacy planning, right? If you have kids, or don't, these are still things you can think about how you can pass down that wealth. Another reason why this type of policy is awesome for parents is for the simple fact that, remember I mentioned to you before that this money can be used for other things besides school. So in year 20, for example, there's approximately $27,665 in the cash value at that point in time. You can do a loan from this policy if you want and take money out. And at that point, as the owner, you can gift that money to your child for school, for a home, for marriage, whatever the case may be. So it's like a bank that you're creating for yourself, where you can take money out, okay? Only thing I want you guys to just be aware of, though, with whole life coverage, this column over here, the guaranteed cash value, does not pay out on death. It's to use while you're alive. So for example, you're not going to get the 100,000 plus whatever this is in this column. This is basically for you to use and borrow from and take from while you're alive. It does not pay out on death. Whereas universal life, where you're putting that extra money in from your own pocket, that does pay out on death, okay? So if you have any questions on that, let me know. But anyways, I hope this didn't confuse you too much, but this is a great type of policy that you can open for yourself as an adult. But in this situation, I'm showing it to you as a kid. This is the type of policy my dad did for me. And this is also the type of policy that I have for my son right now. So every single year, I get a statement showing me my dividend payment, showing me how much extra life insurance it's bought as well. And it's growing every year. And by the time my son is 20 years old, there'll be X amount of coverage in there. And I, as the owner, have the ability, of course, to gift him that money if I want to. Or if he's not financially responsible, I don't have to give it to him at all. I'm the owner, so I can choose whatever I want to do with that. So just keep that in mind. So not everybody has the ability to pay extra for their kids for a whole life policy. It's not exactly cheap. So one of the other options that is kind of popular for parents to add on to their policy is a children's insurance rider. So when you have a life insurance policy, guys, there's different attachments that you can add on. Just like with your auto insurance, you can add on different types of coverage to your policy. With your life insurance, there's different add-ons called riders that you can put onto your policy as well. So the children's insurance rider is one of the popular ones that parents often request because it acts like a term where it'll cover your children up to age 25 for one cost. So if you have 3 kids, once you apply for coverage, you're going to put your 3 kids under a children's insurance rider. And for that extra, let's say maybe $15 a month, it's going to cover all 3 of them for up to $25,000 or $30,000. So I would say it's a less expensive way that you can kind of cover all of your children. The only downside to a children's insurance rider is, like I said, it's not coverage for life. It's going to cover them till age 25. And at that point, they can then convert their rider into their own policy for up to 5 times the amount without showing any proof of health. So what that means is that if you get a child rider for your child, and heaven forbid their health situation was to change, they got some type of illness, cancer, or whatnot, typically, if they applied for insurance on their own, they wouldn't get it because they were ill. But because you got a children's insurance rider for them, they're able to convert their 25K policy up to another 125,000 permanent without answering any health questions. This is called protecting your children's insurability. It's making sure that no matter what, if they were to get sick, they're still able to get insurance in the future. Okay, so a children's insurance rider is excellent to put onto a policy. Like I said, if you don't have the funds to do a whole life or universal life for your kid, this is the most inexpensive way that you can cover your children. And like I said, $15 a month, you can get up to about $25,000 or $30,000. Another rider that you can add onto your policy would be a critical illness rider. So critical illness is super important, especially for my ladies. I mean, I always advocate for my ladies to get a critical illness policy. A critical illness coverage will basically give you a lump sum payout in the event you are diagnosed with a critical illness found within the policy. So an example of a critical illness would be heart attack, cancer, stroke, severe burns. There's a whole list. Most companies have a list of about 23 illnesses. And as long as you are diagnosed with an illness found within the policy and you survive for at least 30 days, they will give you a lump sum payout. So you might be thinking, okay, Nicole, well, what would I use that money for? Well, think about it. If you happen to get a critical illness and you survive, hopefully, most likely you're going to be financially impacted, right? Whether you're doing chemotherapy, you're off from work, like I mentioned before, bills still got to be paid, rent still got to be paid, mortgage still got to be paid, car notes got to be paid. Where is that money going to come from? A lot of the time, people end up depleting their savings, depleting their RRSP, depleting their TFSA they work so hard to build just to pay for medical costs. A lot of people are also under the impression that OHIP pays for all cancer treatment. That's not true. Cancer treatment is very expensive. And whilst, yes, some is covered under, our healthcare system, a lot of it is not. People are forking out thousands of dollars to stay alive. Where does that money come from? They end up going into debt. They end up depleting their savings. So a critical illness lump sum will come in handy to make sure that there's, less financial impact to you. So other things it can be used for in my list, replace any reduced or lost income. Once again, you're not working, can replace your income. It can allow you to hire help around the house because obviously if you're sick, you don't really feel like cleaning, you can hire maid services. You may have to change your home and get renovations due to whatever illness you got. It can be used for that as well. And what's cool about most critical illness policies is that it comes with a second opinion service. So a lot of times people are diagnosed, but they want a second opinion. They're not exactly sure their doctor knows what they're talking about. They kind of want somebody else to look at their situation. Most critical illness riders and standalone plans come with a second opinion service where you'll be set up with world-renowned doctors around the world that specialize in whatever it is that you're going through, whether it's breast cancer, lung cancer. They will look at your file and give you a world-class second opinion with recommendations as well, totally free. And a lot of the times this is available to your immediate family members as well. So even if you're not going through a critical illness, but maybe your mom, dad, or spouse is, once you have a critical illness rider or standalone policy, you can use the second opinion service for your close loved ones as well. So the reason why, like I said, females, breast cancer, of course, may run in people's family. You may know someone that's been affected with breast cancer, but it's so important for us to have, even if it's just 1 times your salary of critical illness, it's important for you to really pay attention to that, because life insurance is not really going to help you, right? We get life insurance for the loved ones that we leave behind. Life insurance is really going to help you necessarily if you're sick because you didn't die. But critical illness coverage now is a living benefit. Life insurance is a death benefit. Critical illness is a living benefit because it's a benefit to help you while you're alive. True story, I had a client that I met with back in 2017. She was interested in getting a critical illness policy because breast cancer ran in her family. So we set up a small policy for her for about $50,000. And it was relatively inexpensive because it was a 20-year term. So it wasn't like it was a permanent one. It was a 20-year term. I think she paid maybe $22 a month for this policy. I got the call just 2 months ago from this same client, unfortunately, that she was diagnosed with stage 4 breast cancer this year. She's the same age as me, 35 years old, okay? So she got this policy in 2017. Fast forward to 2021, she has now been diagnosed with stage 4 breast cancer. And, it just made me feel like so relieved that we got this policy in place for her. Because now, while she's battling this cancer, she lost her hair within a week, taking chemotherapy medication at home, feeling very ill, not working, on disability. Now she's expecting this $50,000 check to come to her for her to do whatever she wishes, whether it's treatment, paying the bills, paying the mortgage. But this is something that, made me feel really good as an advisor that I was able to put that in place for her, because these are things, guys, that you have to put in place while you're healthy. You can't wait until you have a diagnosis or feel that lump in your breast to try and get coverage. You need to get coverage ahead of time, because once you have, an inkling of what's going on or a diagnosis, you'll be uninsurable, okay? Same for life insurance. It's something you want to get in place now while you're young and healthy. So going back to generational wealth, I had to put this picture of this little cottage here. Rich people use life insurance all the time. A lot of people have the misconception that because they're rich or famous, they don't have life insurance. No, they do. Why? Because the assets they work so hard to build through whatever occupation they have, they want to keep that money within the family. A life insurance policy can provide liquid cash upon your death, so your loved ones can use that money to pay any taxes owed, so the assets you work so hard to build can remain in the family. So for example, a lot of us aspire to have maybe a second property or a cottage or whatnot. And once you have a second property, if you were to pass away, you can leave that property, of course, to your kids or whatnot, but a lot of the times they'll be forced to pay taxes on that second property. And if your kids don't have that money for those taxes, they're going to end up selling the house because they can't afford to keep it. So by having an adequate life insurance policy, you can actually take that money or some of that money to pay off, not you, but your beneficiaries can take that money to pay off the taxes on these assets so that they can remain in the family. So that's why I had that picture of that cottage there, just as an example of, if you work so hard to attain something like that, you don't want your kids to have to be forced to sell it because they can't afford to keep it. Life insurance can pay that tax bill, right? And this is where just appropriate planning with your advisor will go over that, and because that's the number one question. Well, how much insurance do I need? So when you're working with myself or an advisor of your choice, you'll be looking at all your assets, all your liabilities, and determining how much life insurance you need to make sure that what you want gets covered. So when should you apply for coverage? The answer is today. Today. You are never going to be younger than you are today. So if you don't have life insurance yet, now would be the time to apply for coverage. Because like I said before, premiums are predominantly based on your age, your sex. So the younger you are now, the premiums are the cheapest and you can lock in that rate. You want to lock in that rate now so that that's the rate you're paying if it's a term for the next 20 years, or permanent, that's the rate you're going to pay for the remainder of your life. Because when you apply for insurance, not only do they look at age and sex, but over here you can see on your right hand side, or maybe your left, there's other factors that come into play. Okay, when you're applying for life insurance, the underwriter who looks at your file are looking at numerous things. There's numerous questions. Family health history is a big one. You don't have cancer right now, but is cancer running your family? Has your father, mother, brother, sister, have they ever experienced or had any issue with cancer? They look at that. Hazardous activities. Are you a bungee jumper? Do you do mountain climbing? Do you jump out of planes? All of those things are important to the underwriter as well. Like, what type of risk do you take with your life? Remember, it's a risk to them to insure you. So they want to make sure that the risk is shared in a sense where if you're too risky, they ain't taking you. Smoking status. If you smoke tobacco, your premium will cost more. Obviously, we know smoking is linked to lung cancer and things like that, so it will cost you more. Marijuana, for example, a few years ago, if you smoked marijuana, you used to be considered a smoker. Now, not anymore. You can smoke marijuana up to a couple times a week and still be considered a non-smoker. So things have changed. Drug usage. Are you taking hard drugs? Are you taking hard narcotics? Those are things they want to know about. And they will find out, because you want to make sure that when you're doing an application, you're being forthcoming and you're saying all of these things, because when you pass away, life insurance companies, they do their investigation, especially if you happen to pass away within the, let's say, 2 to 3 years or 5 years of getting a policy. They look at OHIP records. They look at your doctor's file. They want to see, were you being truthful? So you want to make sure you're divulging all this information that they're asking you, so that when they approve you, there's no skeletons in your closet. You told them everything, they approved you. If you happen to start smoking after, or let's say you dabbled in a drug after the policy's been approved, that's different. But up until the time of application, you want to be super truthful about your past experiences. Driving record. Do you have a DUI? That's big for life insurance companies. Do you drive under the influence? You'll probably get a decline for that with a lot of companies. They don't want to take you on because, you drink and you drive. That's a risk to them. Height to weight ratio. Most insurance companies have a chart or a build where basically, if you're considered healthy and your height and weight falls within a certain guideline, it's okay. However, if you tend to be a little bit on the larger side, or maybe even too skinny for your associated heights, this doesn't mean they're going to decline you, but you may end up paying a small percentage more, a higher premium than person A, because you fall outside of the guidelines. Okay, so these are some of the factors that life insurance companies look at when they're going to approve you. But on the bright side of things, if you are somebody that does have some health conditions, if you are somebody right now that, let's say, had drug usage in the past, or suffering through something right now, possibly, there are other companies that will take you on. So myself as a broker, that's my job to kind of figure out what your health situation is right now and align you with the appropriate company that would best suit your needs. Because not everybody is going to get a traditional carrier. Some people need something called simple issue coverage. You may have seen on TV, CPP, Canada Protection Plan. They're big in that space. They take on a lot of older clients and people that have health issues. So don't fear that you're not going to get coverage because you have some health issues. You still can. Just know that you might pay a little bit more than somebody else that's healthier than you. All right. So things to remember. In times of turbulence, life insurance can basically be the greatest asset you own. Okay. The longer you put it off, the more expensive it gets. You don't want to wait until you're 50 or 40 and say, oh, I'm too young to get life insurance now. No, you need life insurance now. If somebody is going to have to pay for your burial, whether it's your mom, uncle, dad, brother, sister, you need life insurance now. This is exactly why we're seeing, GoFundMe and all that, because GoFundMe for a lot of people, it's literally just an example of poor financial planning. GoFundMe wouldn't really need to be there if proper insurance planning was in place. And as you can see, with term coverage, it's very inexpensive. $12 for $100,000. that's more than enough to cover a funeral and leave, your parents or your brother or sister or whoever with something. Okay, so it's a lot more affordable than you think. Your future health is not guaranteed, like I just said. So if you're healthy now, no health issues, definitely connect with myself or an advisor to look at a coverage that's right for you, because you don't want to wait until something happens to apply for coverage. And lastly, remember, the rich use life insurance to keep their assets in the family. You can do this too. So rich people, they don't want to use their money to pay for taxes and all that. They use life insurance. They have money to do it, but they want to keep the assets in their family. You can do that too. And even if you don't have assets yet, life insurance can be that first asset for you with a whole life and universal life policy. Okay. So I want you guys to stay in touch with me. This kind of wraps up my presentation. If you're not following me online, you can follow me online at Advisor on the Go. And if you're interested in knowing more about Seeds for Success, like I said, our non-for-profit, you can follow us on Seeds for Success _ at Instagram as well. Unfortunately, you guys are catching me at the end, basically in a sense where I will not be working shortly as I prepare to give birth, but I still have spots opening this week for life insurance consultation. So please, you can head over to my Instagram page, hit the link in my bio, and book a life insurance consultation with me this week, where we can go over your numbers, look at exactly what you're trying to protect, look at that legacy that you're trying to build for your family, and I can provide some recommendations for you. Okay, so I hope you guys found this informative. And if you have any questions, now is the time to ask. Thank you so much.
Thank you so much, Nicole. And if you guys have any questions, now is the time. You can go ahead and ask her. Let's see if there's any in the chat. So we have a question from Imanzi. He said, how much life insurance coverage should you have as a young professional?
Yeah, great question. Once again, it's kind of hard to say. I'd have to see your actual, situation. When it comes to my process, when I'm working with somebody, like I said before, we look at your assets. What do you have saved so far? Look at your liabilities. What's your debt situation like? Do you have credit card debt? Do you have student loans? All of that. And then from there, we take a look at what your goals are. Are you interested just in paying for burial? Or are you a young professional with kids and you want to make sure that you have money for burial and kids and legacy? So all of those information I would get in our consultation, and then I would be able to provide you with a quote or a number. And from there, we'd go back and forth where, you feel comfortable with the number that we selected. One thing I want to mention to you guys too that I forgot to say is that a lot of people are under the impression that you can only have one policy. If you're a young professional, especially now with no kids, you're not married, your life is going to keep changing and your financial situation is going to keep changing too. When I got my first policy, I was 27 years old, no kids, didn't own a home. When I purchased my first home at 23, I had to buy more. When I had my son, I had to buy more. So don't think that your first policy is your be all end all, got to get it right. Your finances are going to keep changing. And that's why your life insurance policy should be reevaluated every 2 to 3 years or with every life-changing event to see if you need more. Okay.
I also have a question. How early can you expect the returns? Let's say you take that insurance for 20 years. With each policy you get, how early can you expect the returns?
Sorry, so rephrase that for me. You're saying with a term policy, what returns do you get?
With any policy that you mentioned before, so how early can you expect the returns? Let's say you took that universal one. How early can you expect to get money to get to buy your house, whatever you want to pay out? Yeah.
Okay. Well, in the example of universal life, remember, that's dependent on you and how much you're putting into the policy extra. Because remember, universal life allows you to overfund the policy, so put extra money into the policy, right? So if you're minimum funding, not putting in anything, there's not going to be any cash value growing. However, if you're putting in $100 a month or $250 a month, that basically is going to determine how fast you get to your goal of whatever that is, right? So if you're asking how early can you see returns, You can see returns as early as year one in regards to the money compounding over time, but it all depends on how much you decide to overfund. On the whole life side, like the example I showed you before, the first 5 years or so, the guaranteed cash value is not much, right? So it's not enough to buy a home or anything like that. You really have to give the policy time to grow in order for you to see a significant amount to do something. So that's why, for me, I position it in a way where if you have it for a child, by the time they're 25, 30 years old, there should be a significant amount for them to use to do something. But you're not really going to see a huge amount within the first 5 to 10 years, to buy a home or anything like that. It's more something you're supposed to wait, over time to accumulate that wealth.
I see. See if we have any other question in the chat. So we have a question from Lydia. She says, let's say you're a parent with younger children and you do not have a family member to add as the beneficial or a person to make decisions on your behalf in case you pass away and your kids are young. How do you decide who will be in charge before your kids turn 18, or what should you consider while getting a new life insurance?
Well, from my experience, most of the time people have some type of family member. When you don't have any family member to put on an insurance policy, then the policy death benefit will go to your estate. So your estate basically is when you pass away, all of your assets will be sold at fair market value and basically be put into this pot where hopefully if you have a will, your will be able to, distribute the money effectively. So for example, if you have $100,000 that goes into your estate and you have 2 kids, you can put in the will and in the insurance policy that the money is supposed to be split up. But whoever is doing your financial affairs, there's going to have to be an executor for an estate. So it still involves somebody. That person and the courts that administer your will then make sure that that money goes to your kids. So it's hard for me to say, who you should choose, but it would need to be, you can still put a friend. It doesn't have to be a relative. It could be a friend. It could be an aunt. It could be an uncle. They don't even have to be in the same country, to be honest. But you want to pick someone that you trust and just know that you can put them down there for now. And then if things change, you can always change that beneficiary as well. But if you are unable to pick anybody at all, the death benefit will go to your estate.
Okay, thank you so much. And we have another question from Axel. It says, should couples get insurance as a unit or individually? What do you think?
Good question. I say individually. I very rarely provide solutions for couples just because, I don't want to be negative Nancy, but if couples break up or there is a marital breakdown, it's just easier and just better if people have their own coverage. So often I work with couples. I'm working with a couple right now where, her needs might be a little bit different. His needs might be a little bit different. But I often personally, and even for myself, I have one, my husband has one separately. I just like the idea of having separate, just for the simple fact that, if anything changes, you can go on your way with yours and I can go on my way with mine, Oh, you're on mute, Joyce.
Oh, sorry. We have another question from Vanessa. She says, what are the key questions to ask when shopping for life insurance and what to look for in terms of great quality of life insurance? Any resources for someone who would need more information on the presentation?
Okay, sure. So yeah, obviously there's tons of life insurance companies, Manulife, Sun Life, RBC, BMO. That's actually one of the benefits of working with myself because I'm a broker. So I'm not basically contracted with just one company. I kind of have access to all of them. That's my job, to align you with the company that matches your needs. But in regards to resources, you can check out, companies' websites for statistics. You can check out their websites for, claims and claim rates and how they pay out things as well. But back to your question in regards to some of the key things to, ask or whatnot, it's kind of me more asking you, right? Because me as the advisor, it's my job to find out what that need is. What are you trying to protect? Are you only concerned about burial? Are you concerned about legacy planning? Are you concerned about creating wealth? Do you have extra money to overfund a policy? So those are all things that we would figure out in our conversation. But I think where you should just start, just for yourself, is ask yourself, that original question, what legacy are you trying to achieve? You know, right now, maybe you want to achieve a financial legacy, but right now things are a little bit tight. You don't really have the money to have $100 policy. Look at term. Look at term. You're able to get a large amount of coverage, as you can see, for a really small rate. And at any point in time, I think I forgot to mention this, if you start off with getting term coverage now, because of affordability reasons, you can convert your term to permanent down the road. The only thing is you have to be mindful that you're older. So if you convert 5 years from now or 10 years from now, it's going to be based on your age at that time. So think of life insurance as being on sale now. If you like the idea of permanent, incorporate some permanent into your plan. You actually can have a mixture of both. You don't have to choose term or permanent. You actually can have one policy that has term and permanent combined in one policy. So you don't have to choose. So just know that, you know, if term is affordable for you now, get that. It's better than having nothing at all. And you can always convert to permanent down the road. Just be mindful, you don't want to wait too long because the price will increase a lot due to your age. You're on mute again, Joyce.
Oh, I keep forgetting. Sorry. Yeah, I should say you look good and congrats on the baby girl. And
Thank
she wishes you
you.
a smooth delivery. We have another question. Are critical illnesses insurance term or permanent?
Good question. So there's actually tons of options. So you have the option to get a critical illness attached to your life insurance policy if you want, or you can get a standalone policy where it's separate. So you have your life over here, critical illness over here, and you have the option with critical illness to get a term 20, term 30. Some companies offer term to age 75, 65, excuse me, and a lot of companies offer age till age 100 as well. One of the benefits of getting a critical illness policy on its own is that you can get something called return of premium. Return of premium means that if you don't get sick and if you don't make a claim by a certain year, usually maybe by age 65 or in some policies starting in year 15, you can get your premiums back. So this is actually one of the types of insurance. Life insurance doesn't offer that. But with critical illness, it's one of the very few insurances that you actually can get your premiums back if a claim is not paid. So you'll pay a little bit more for that per month, but at least you know down the road, hey, if I never get sick, if I never claim, in my older age, when this policy ends at age 75, I'll get all those premiums back. And think about it, at age 75, you're retired. So if you're gonna get a check for 30, 40K, trust me, I'm sure you'll need it at that point in time. It can be done, you can use for a lot of things. So return of premium is offered on standalone critical illness policies.
All right. I have another question. So you mentioned about them asking about your health and all that. Is there like some exams that are done to ensure insurability or something? Like, do they have to do exams? Oh,
yep. Good question. So COVID actually changed a lot of things. You know, prior to COVID, life insurance companies had like a limit. So for example, if you were to apply for more than 500,000 with some companies, you would have to do something called a paramedical. A paramedical is basically when health questions are asked, but on top of that, a nurse from a third-party company could come to your home or workplace, and they would either need from you or both blood. So they would take blood from you and urine. So this is a way for the life insurance company to know that, of course, you're healthy, nothing is going on, right? Blood and urine would be required. However, since COVID, things have changed. Obviously, people weren't seeing each other. Nobody wants random strangers in their house. So insurance companies actually raised their limits, where a lot of insurance companies now, you can get up to $1 million or even 2 million with no medical. So I have tons of solutions right now. So it really depends on which company you're going with. But I would say majority of companies right now, if you're applying for $1 million and under, there's no medical exam. All you have to do is answer just the health questions.
Okay. And is this death benefit adjusted to inflation, or it's from the time you got it? So like the money you get, is it adjusted to current inflation or not?
Some insurance companies have an option, a rider that you can put on to adjust to inflation. But majority of the time, if you don't choose that option, it's just whatever you signed up for. So if you signed up for 50,000 back in 1991 and it's now 2021, it's still just going to be 50,000. However, if it's a whole life or universal life and you were paying extra money into it and there's cash value there, then, you know, it's possible that it could be more than that, right? It depends on what type of policy you have. But if you want inflation to be something to consider, then there are, you know, little bells and whistles you can add on so that your death benefit does increase over time.
Okay. And one last question:
Sure.
can anyone? You mentioned about that. Let's say if I had a beneficiary as my child, I can change them anytime, or is there like a restraint on that or not?
If you have your child as a beneficiary?
And I want to change them and put somebody else. Is
Yeah,
there
yeah,
like I can always
absolutely.
do that? Oh, okay.
Yep. So once you take out a life insurance policy and you're the owner, you have the ability to change the beneficiary at any point in time. The only time it's restricted is if you have chosen to make them irrevocable. Irrevocable means, let's say that it's a couple, husband and wife, and they want to put each other as beneficiaries, but they don't want the husband to be able to change it and put somebody else. You can make your beneficiaries irrevocable, which means that in order for them to change it, you have to sign off on it, right? So for example, if a husband puts a wife on and the wife doesn't want him to be able to change it, if he makes it irrevocable, she would have to sign off on that change. It would require her permission. Okay. So that's an example of where someone might want to make it like very stringent, like, no, you can't change it without my permission. But in most cases, as long as you make it revocable, you have the ability to change it at any time. It's not written in stone. Like, for example, right now, I have my son on my policy along with my husband and whatnot, but I have a daughter coming soon, right? She's gonna need to be added as well. So after she's born, it's just a simple form that I have to fill out where I'll rejig the allocations and the percentages, but I can add her to my policy, you know, right after she's born, after 15 days of life.
And what happens if your beneficiary dies before you?
Good question. So when we're doing the application, there is a spot on the application where you can put a contingent. Contingent means who would be next in line to get this money if my beneficiary dies. So if you put your uncle on there, for example, and your uncle happens to pass away, well, if you're still alive, you can just change it to whoever you want. But let's just say you and your uncle passed away together in a car accident. If you had put a contingent on your policy, that person that was the contingent for your uncle would take the place of your uncle and get your uncle's portion. So long story short, it's important to, you know, put a contingent on there just in case, because you never know.
And you can always put them along the way. You don't have to do it when you sign for the policy.
Yes. Yeah. A lot of people have a hard time just figuring out who the beneficiary should be, much less another person on top of that. So you don't have to think about it right away. It's just a form that you would have to sign off on later to say, okay, I want to add this person as a contingent. You would send it to the insurance company and yeah, they can make that change for you.
All right. And also one more question. Let's say I have a kid right now and I die. How do you have to wait until my kid is 18, or they can get the money like right away?
That's a very good question. I'm glad you asked that, Joyce. So whenever you put a beneficiary onto a policy, if they're under the age of 18, the life insurance company is not going to hand them a check. They're a kid. My 8-year-old is not going to get this money if I pass away. It's going to be held in trust with a trustee. So anytime you put a minor onto a life insurance policy, you're going to have to name a trustee. So that's either their father, your sister, and you're going to pick whoever that is. But basically what happens is, let's just say it's for $100,000. The trustee, the life insurance company will make a checkout held in trust for your child to the trustee. And it's basically the trustee's job to oversee the money until your child is 18. So the trustee can't use the money or anything like that for themselves. I believe they're able to access the money if they can prove it's for the child. But until your child is 18, your child basically can't touch that money. The trustee is the one that's in, you know, the trustee is the one that's basically the one that's going to oversee that amount. So you want to make sure it's someone that you trust. And even at 18, I mean, think about it. At 18, you know, if you get a check for 100K, what you gonna do with that? Like, you'll probably go shopping, you'll probably go downtown to Yonge Street, buy clothes, and who knows what you're gonna do with that money. So one further step that you can do is you can create in a will, or you can have a trust account where, kind of like what Whitney Houston did for Bobby Christina, her daughter, where Bobby Christina was only able to get certain amounts of money at certain ages. So those are all things you can do with a lawyer as well. If you don't want your kid to get the money at 18, all of it, because they're not really that responsible at 18, you can set other things up so that they're able to get the money in increments. So you would talk to a lawyer about that.
All right. And let's say some misfortunate happened along the way, somebody trusted, it's not trustable anymore. Does the insurance company have a say? Let's say a child wants to sue their trustee. Does the insurance company assist in a way, or it just has to be on your own?
Sorry, that's if you don't trust the trustee anymore?
No, if you trust the person, right? And
Mhm.
let's say you die, right? Because they have to take over with your kid. But then people change,
Yep.
What would happen? Let's say the child wants to sue the trustee. Is the company going to assist them, or it's just on their own since they have their money and all that?
Well, I haven't experienced that yet myself, so I don't have the 100% answer, but I feel like the life insurance company wouldn't have much to do with that, because it's really just only their job to do what you said in the application, right? So once they do their investigation, they see that, of course, the death benefit should be paid out, and they write that check. To me, that they fulfilled their financial obligation. So at this point now, if the child decides to sue the trustee and all of that, I mean, they can get the life insurance company involved. I don't really know how much life insurance company would be, at stake after that, because they did what they were supposed to do, right? So that's something that's probably going to have to be fought out in court, I guess, if the child wants to sue them. There's a question here about COVID-19. With COVID-19 on the rise, does having COVID-19 positive result in your health record increase your premium? So great question. As of right now, I haven't seen that yet. Life insurance companies they have incorporated COVID-19 questions into the apps, like, have you traveled in the last 14 days? Are you experiencing any cough, sickness, illness, all of that? From my experience, if you've had COVID already and you're fine now, you're still accepted. You obviously don't want to apply for life insurance right now if you have COVID, because I think that would be a decline. But no, there's no premium that's going to be risen because you've had COVID in the past or anything like that. Just know that in order for you to apply, you should wait, of course, till you're healthy, you're good. COVID was maybe 2 months ago, 3 months ago, for a better chance of you getting approved. But they're not going to give you a higher premium because you've had COVID or anything like that.
Okay. Thank you so much, Nicole. Is there any other question? Seems that there is not. I would like to thank you so much for your time and for the very informative information that you gave us. And if anyone wants to go ahead, you can always sign up in her bio on Instagram. You can find it on the flyer, or you can also ask at CARY. We will give you the information that you need so you can get in touch with Nicole.
Thank you guys so much for having me. I hope to hear from you. Like I said, I wish everybody an amazing, prosperous next rest of the year for sure. And like I said, if we don't connect now, feel free to reach out to me, whether it's this year or next year. I'd love to hear from you and answer any questions. But once again, link in my bio to book a consultation. And yeah, I hope you guys enjoy the rest of your weekend. Thank you so much for having me.
Thank you so much, Nicole. Have a great weekend, and everybody else.
Thank you.
Thank you, Nicole. And we wish you a healthy delivery and a safe pregnancy.
Yes, thank you. Wish me a pain-free delivery. It's all I want. Just pain-free.
Oh, yes, pain-free. And you look great, by the way. We could not see a change between your face now and the face on the picture.
Gosh. No
seriously.
way.
And
it's like it's two different people.
You look great.
Thank you. I appreciate that.